Have you ever heard that voice in the back of your head telling you to invest in rental properties? As they might be really beneficial for some, they're not as great for others. So I'm going to go through some pros and cons of rental properties in this video and whether it's the right decision for you. There are obviously flip sides to every coin. Some people prefer to have their money invested in the markets, where others prefer to leverage it in real estate and try and grow their wealth through that form of investment. So now let's look at four key forms or four benefits to investing in real estate. And the first one being cash flow. By investing in real estate, obviously you're going to have some rental income, which comes in the form of cash flow. This is really nice to see because it's a passive form of income where you're not having to work for this money, but it's still coming in on a month-to-month basis. The next benefit I want to look at is appreciation. So as you're earning that, passive income, as you're earning that rental income, your asset behind that is also growing. So not only are you earning, that rental income on a monthly basis, but you're also able to receive, or you're also able to see the growing asset, the house or townhome or condo or whatever type of rental property you own, growing in the background to eventually liquidate one day and use for retirement. So another key benefit is the tax benefits of owning a rental property. That is the tax deductions that come along with such investment. So you're able to deduct a lot of the expenses that come along with owning this property and maintaining that property through its lifetime. So the last piece of benefits that I want to kind of touch on today is the hedge against inflation. So in most provinces, you're going to have a restriction on how much you can increase rent by on an annual basis. In this case, we're going to just kind of mention the fact that you're able to increase your rental income on an annual basis just to keep up with inflation. So in all of our plans, we're just assuming that 2% growth on it to keep up with inflation is going to be seen, meaning you're going to see 2% more on an annual basis in your pocket than you would see in another type of investment. Now, obviously, investing in rental properties comes with some risk. And there's four key points that I want to touch on today as well. And the first one is the risk of vacancy. And the concept behind that is basically you're not always going to have someone in that property that's going to be paying you rent every single month for the lifetime of the ownership. You're going to have months where there's vacancies and you need to be able to be prepared for that. The next risk that's involved is maintenance and repairs. Obviously, with owning an actual property or owning this tangible object, there's going to be some different types of expenses you'll have personally in order to maintain this property and make sure that it's actually rentable versus having a rundown property that's going to lose its value, that's going to lose its kind of appearance and lose its potential as a property to generate income. Now, this third risk is, I'm sure, well known and probably the greatest risk, and that is problematic tenants. So if you have tenants in your rental or in your rental property who are causing you troubles, there's not a whole lot you can do. So make sure you're taking the time to vet your tenants before they come in, before they move in, and make sure that they're actually going to be there for a reasonable amount of time because you don't want to have to keep dealing with new tenants all the time. So just make sure to take your time in vetting those tenants and making sure that they're the right fit for you and also for the property that you own. And the last piece of information, the last risk I want to touch on today is market fluctuation. So this has to do more so with the underlying asset of the actual property, not always growing in value. So as you'll see in previous years, we've seen exponential growth in that rental property value. There's also years where we see a negative return on those investments, as we've seen in the last few months here as the markets kind of settled down, cooled down, and values of those homes, those rental properties, even your principal residence, I'm sure you've seen it come down over the last few months here as well. Now, associated with these risks come common mistakes with rental properties. This really does tie into risk overall, and those four key points, those four common mistakes I want to outline, and I'm just going to briefly touch on them today, are lack of preparation for actually purchasing the property. You're not spending enough time in researching the neighborhood or the area or how much rent and the difference between your mortgage and rent you could be earning on those properties are. The next one I want to look at is tenant screening. So I mentioned it before, but basically not spending enough time in researching or in kind of questioning your tenants, your future tenants, to making sure that they're a good fit for you and a good fit for your property. Property management is a huge thing. Either you're not considering the cost of having someone do this for you, or you're not calculating in the time that it's going to take in order to manage this property ongoing to make sure that it does stay valuable and it also does stay livable. And the last one here is just bad financial management. You're not managing your expenses and the income and making sure that you're able to generate the most profit as possible from these property incomes throughout the lifetime of ownership. Now, there's 6 key steps to actually follow when purchasing a rental property. Now, the first one being is determine your budget. You need to know what is actually affordable to you. So this doesn't just include the down payment amount. This also includes going to figure out what you can get for a mortgage rate for renting out a property, as it's not going to be your standard rate. Typically, they're a little bit higher than you would see for your principal residence. You're also going to need to recognize whether you can handle this mortgage if there isn't anyone in the property at that period of time. So as I mentioned before, sometimes you're going to have lapse in tenants. You're going to have a period where you need to sustain this mortgage personally. And are you able to afford that if there's no one in that property? The next step is research. Research the properties, make sure that it is valuable and that it is worth what you're purchasing for. Get someone to evaluate it. The next is research your neighborhood. Make sure that the neighborhood you're purchasing in is actually sought after by renters, because if you're not buying a property in somewhere that's sought after, then you're gonna have a hard time finding someone to rent from you. Research the investment potential. So make sure that you're actually getting a reasonable rate of return between how much you're paying in a monthly basis on mortgage and how much you're actually able to receive on a monthly basis in rental income. Now, once you've done all that, the next step is really just to negotiate. Try and find a price point between you and the seller that you're able to afford and you're able to kind of feel confident with before purchasing that property. So get that negotiation going and get to a price point that you're happy with. And then the final step is making an offer and then starting to advertise and get the information out there that this property is now for rent and that you're able to actually get someone in that property in a timely manner. Thanks guys for watching our video. If you're interested in more content like this and interested in more financial education, head on over to our masterclass. You'll see a link below in our bio as well that gives you $100 off at this time. So take advantage of that and really advance yourself in your financial education going forward.